class on moving average convergence and divergence, better known as MACD, or the Great Momentum Indicator. Now, there are some handouts on your screen. If you notice, there's a little box on your screen that says handouts. I've put together a handout on today's class called the MACD Indicator Guide. It covers everything we're going to cover in today's class. I've also given you the Technical Indicators Guide from investing.com. Both of these are excellent resource materials. There's nothing you have to buy, nothing you have to pay for, nothing you have to enroll in, nothing you have to do except click the download buttons, download them to whatever device you're using, because they're not available except at any other time except in this live class. And then once you've downloaded them, you can move them around to wherever you want later and use them at your convenience. Now, in today's class, I'm going to use the term security, but I might say Facebook, I might say Google, I might say Bitcoin. I know I'm going to say the euro US dollar, but I'm not talking about any specific instrument. I'm talking about today all tradable instruments in which a liquid market exists. Similarly, I intermix the terms investing and trading. Now, you and I know the difference. Most of us are here because we're traders. Traders take short-term positions to make profit and move up or down of the immediate markets, where investors are looking to own assets and slowly have them go up in value over time. Now, whether I'm giving a webinar, whether I'm doing a presentation, whether I'm meeting traders on a one-on-one, I'm at a seminar, I'm at a conference, doesn't make a difference. It seems like the first question people ask me is, what should I buy today? What should I sell today? I can't tell you how many phone calls and how many emails I've gotten. Do you think the S&P is going to bounce back? What do you think Wall Street's going to do? Do you think Bitcoin's going to go back up to 9,000? Do you think the euro is going to fall back to 106? To be honest with you, I have no idea. And neither does anybody else. So what will prices be tomorrow, next week, or next year? Well, wouldn't investing be easy if we all knew the answers to these questions? But I don't have a Ouija board and I don't have a crystal ball. So if you're attending this class in the hopes that technical analysis using MACD is going to provide you some kind of magical answer, it's not. However, you're attending this webinar with the hopes that technical analysis using MACD will improve your investing and trading. That, I have good news for you, that it surely will. So let's get started talking about one of my favorite indicators. And if any of you've ever attended my classes before, you know I don't really use indicators. I use chart patterns, I use support and resistance, and that's about it for me, okay? Sometimes when the markets, I can't make heads or tails, or I need a little bit of help, I will use an indicator. And to me, that indicator is using MACD. It helps me interpret what the market is trying to say to me when I can't understand what it's saying. Now, MACD has been around for a very, very long time. It is one of the most respected indicators in the marketplace. It helps us see strength, direction, and momentum and the duration of a trend. Well, that's a mouthful, isn't it? Now, since MACD was developed by Gerald Appel back in the 70s, if you all came back, or as old as I am, you'll know that in the 70s, the markets moved very slow. I traded agriculturals back in those days in the pits. And we did all the charting by hand. We got our numbers by ticker tape. We barely had faxes. There was hardly any computer. There was no PC. There was no internet. Computers were these things that took up great big rooms that would print out, some data cards to give you some collation of data. But that's about all it did. Okay. And MACD was introduced by Gerald Appel, and it was mostly for the stock market. And if you were a stock trader and you were doing, your calculations, believe me, the big stocks in those days were like GE Capital. No, it would go up a little bit, it would go down a little bit, it would go up a little bit. It would be at 1350, it would go to 1360, and then go down to 1345. And that would be the extent of it for the day. And if you notice, I didn't say 13.45789. And MACD got a very good reputation in those days. But the world changed radically. We got online trading, we got the internet, and we got Forex trading. most indicators do not make the transition from a very fast-paced, hectic market from a very slow-paced, hectic market to a very fast-paced, hectic market. MACD is one of those indicators that has been proven to work just as well in the Forex market as it did in the stock market. It proves that it works very well in very short-term time periods, and therefore it's become one of the most popular Forex indicators. Now, the best function of the MACD Forex indicator is to discover new trends and to help identify the end of current trends. There are various ways to gauge the signals generated by MACD, and many traders use their own unique settings and methods around this indicator. Now, the MACD indicator is typically placed at the bottom of your trading chart in a separate window beneath price, where most indicators go. The Moving Average Convergence Divergence is a relatively easy tool to use, but here's the piece of information. We're going to spend a lot of time on this today. It is crucial to understand it fully before attempting to trade using its signals. Too many people want to read a little guide, like that technical indicator guide I just gave you from Investing Up. It says, when you get a crossover going this way, when you buy, when you get a crossover going that way, sell. No, that's how foolish people trade. You have to understand what causes those crossovers, when to know when they are good, when they're valid, when they're not, how good that crossover is, and what you should be doing and what you should be correlating it with. So today, we're going to go to the basics. So let me pop up a live chart here for you. And as I said, we're going to be looking at the euro today. There we go. This is my standard teaching chart. So I haven't picked the euro because I'm making any advice on there. Although it did take a big fall, so at 108, 108.74. I've still got a little way to go lower. But this is a chart, and we're looking at a 60-minute chart. That's a 1-hour chart of the euro US dollar, only because it is my teaching chart. Now, MACD starts out just like the name, Moving Average Convergence. So the first thing MACD does is it uses a 12-period moving average to start its calculation. So I popped that on your screen. You see the gold line going across your screen there. That is a simple, standard 12-period moving average. Well, there's not much we can do with it. There's lots of trading strategies that incorporate moving averages. Like we have red light, green light. You would only buy when price is above the moving average, and you'd only consider a sell when price is below the moving average. Moving averages can be used for lots of things, but that's not a strategy. It's not an indicator we're thus spending our time on, so to speak. But then MACD uses a second indicator, a second moving average, which is a 26-period moving average. So now we have two moving averages on our chart. And we can see that at some point, the purple moving average crosses over the gold moving average. Or we could call the gold moving average the faster moving average and the purple moving average the slower. Why? Whenever the longer the period is, it's always slower than a shorter period. And if we were to trade those crossovers, we would be simply trading a moving average crossover strategy. There's a million of those using a 9 and a 30, a 12 and a 20, a 6 and an 80. God knows there's 3 moving average strategies, but that's only the beginnings of MACD. And again, it would be a very simplistic moving average crossover strategy. Well, that's only where Mr. Appel started all this. So what we do is we then take the difference between the 12-period moving average and the (26-period) moving average. Now, if you notice, they cross over in the gold moving average and subtract the purple moving average. Every time they crossed over each other, we'd be subtracting the exact same number, so it would always be 0. When the gold moving average is higher than the purple moving average, it would always be a positive number. When the purple moving average moved above the gold moving average, it would be a negative number because we're subtracting a larger number from a smaller number. That's just pure mathematics. So what we do, let's erase those lines here. What we do is we drop that below as part of MACD. So MACD uses what we call the MACD signal line. I'm sorry, the MACD line. That I just put on the bottom of your screen. Now, all that line is the difference between the two moving averages above. Just what we did. If you notice, it's the zero, it's the zero. So down below, let's see if I can get this on there correctly. So I just put that yellow line on your screen. The yellow line is the zero. Okay. So when it's at zero, we know we had a crossover at the top. When it falls below zero, we know the purple line is larger than the gold line. When it's above zero, we know the gold line is larger than the purple line. Correct? Simple math, simple addition that we learned in school. So at this point, we can remove the moving averages from our charts because we don't need those anymore, because everything that was contained in those is contained in this blue line below. Now, again, this is only the start of the MACD. Gerald Appel went on one step farther, and what he did was took a 9-period moving average of the value of the blue line. So if the blue line was at zero for the last 9 periods, you add it all together and you get a moving average of 0. And we drop that on the chart, and that is known as the signal line or the trigger line. Because slightly different than the moving average crossover strategy we talked above, when the signal line, in this case the gold line, crosses the blue line from above or below, it signals or it triggers a transaction alert. So when we get crossover here, crossover here, crossover here, it's giving us a buy or a sell alert. If it crosses over and then comes below, we're getting a sell alert. When the blue line crosses above and above, we're getting a buy alert. If you notice, the one thing I didn't say here is buy or sell. I said alert. And MACD does not at any time tell us how far that move should be. It doesn't tell us how deep it's going to be. So it doesn't tell you if that buy or sell alert is going to be profitable for us as a trader. The markets will move that way, but it may not move enough to be your spread, or you may not be able to get into it fast enough before it reverses back. So it's not telling you, Barry, buy. It's saying, Barry, there is a possibility to buy. Do further analysis now. Okay. It is an alert. Okay. Now, this is the beginnings of MACD. We still go a little bit farther, and then we go to my favorite step. Now, when the MACD and the MACD signal line, the gold and the blue line, cross each other below, what do we get? Get a zero. The depiction is simply a graphic depiction of the difference between the blue and the gold line. Now, technically, I could remove the MACD line, the MACD signal line, and trade only from the histogram. Now, the histogram is a visual representation, not a price. Okay? It's not showing us what price is necessarily doing. It's not following price. It's a visual representation of what the indicator is doing. Okay? So when we see it move from the green to the red or the red to the green, we know that the moving average and the MACD line, or the MACD line and the signal line, crossed over each other. We can also see overbought and oversold conditions. When we see huge peaks like this, let me get my marker back on here for a second. Okay. We know we're getting into an overbought situation. When we see huge peaks like that, we know we're getting into an oversold indication. So we have our buy and sell alerts. And we also have our overbought and oversold conditions. We also can see the speed of the price movement. Like here, we have virtually no movement. We have very, very little speed. Even though price is still moving up, we have very little speed or very little momentum in this trend. We can see we have very little momentum. Here, we can see a nice uptrend. We have nice steady momentum. Here, we can see in just the indicator, without looking at price, we can see that we had a rapid downtrend, a rapid decline in price. So we're getting a visual interpretation of what price is trying to tell us. We can also see divergence. Now, I don't trade divergence at all. Okay. Divergence is available in all indicators, but divergence is like here, we see the price moving up, but we see the indicator moving down. It is diverging from where price is going. So what do we got? We have the speed of the price. We have the momentum of price. We have the direction of price. And so everything we need about price movement is available in this indicator. Now, most people aren't me. That's not saying I'm better or worse. Most people aren't me, okay? And they prefer keeping the lines on the chart. And they use the lines, the MACD line, the signal line, as well as the indicator to help them understand what price is trying to tell. Okay. Me as a trader, since I'm using mostly trend line, support, and resistance line, where do my support and resistance lines go? As well as my trend lines and my chart patterns, I don't use the rest of this stuff. I don't know what happened to all my support and resistance lines. They went away. That's really quite unusual. Something must be happening at TradingView because I didn't take them away. Usually my charts are covered with all of my support resistance levels. Ooh. Okay, that's all right. So this is how, so now what we've done is we've actually put this indicator on our charts. Okay, now that we have it there, we understand all of these lines and what makes it up. Let's talk about how to use it. Because now that you understand it, we need to now try to make it worth having. So let's go back to my PowerPoint. So again, the MACD histogram is an elegant visual representation of the difference between the MACD and its 9-period moving average. The histogram is positive when the MACD is above its moving average, and the negative when the MACD is below. The MACD indicator is both a momentum oscillator and a price-based oscillator, and is one of the more reliable studies that we have. While it's a lagging indicator, now keep this in mind, MACD is a lagging indicator. Most indicators are lagging. It's not like in school when your teacher tells your kid's lagging behind. Leading indicators are predicting what the market is about to do. Lagging indicators kind of tell you what the market has just done. Okay. There's not a good or a bad. Most indicators are lagging because they require the input from the last trading session or the last candle to do its calculation. So that candle is over. Now, there are ways that we can move or adjust this to become closer to a leading indicator than a lagging indicator. So it'll help us see what is happening in the markets a little bit faster. And we do this by making some adjustments. Okay, and this is where you can get into personalizing this indicator. The way we can do this is, number one, is let's go back to our settings. Okay, and we go to inputs. Is that, okay, MACD is always going to use the close. And we can change the signal smoothing period to a shorter smoothing period, which will give us a faster response. The smoothing period is the trigger line. So we used a 12 and a 26. And we can also change our precision. And what the precision will do is it will push our moving averages a couple panes forward and help us with our and by pushing the moving averages a little bit forward, what we do is we get a faster calculation, and then we get a more accurate, we're not going to ever move in front of price. Okay. Now we could do this by adding in a displaced moving average, but that gets a little bit hairy. Now I use displaced moving averages all the time, and we have a whole class on displaced moving averages. This doesn't change the calculation. It just means you put the dot on the chart a little bit, 1 or 2 or 3 time frames forward. But it's a way that you can move this farther from a farther lagging to a shorter lagging or less lagging. Now, in downtrending markets, the fast moving average will move down faster than the slow moving average. As the fast moving average diverges from the slower moving average, the MACD will illustrate that relationship. In uptrending markets, the 12-period EMA should move up faster than the 26 period. As such, MACD will move higher to express the growing difference between the 12 and the 26. So MACD is the story of 3 sisters, so to speak. There are 3 popular ways we use MACD: for crossovers, for overbought and oversold conditions, and for divergence. Crossovers, we talked about. The basic MACD trading rule is to sell when the MACD falls below the signal line. Similarly to a buy signal occurs when the MACD rises above the signal line. And as I said, it's not a go buy now. It's a go buy alert telling you here's a buy opportunity. Go do your analysis. Now, the MACD is also useful as an overbought or oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, it is likely that the symbol is overextending and will soon return to more realistic levels. So when the one moving average dramatically falls away from the other moving average, what do we end up seeing on histogram? We end up seeing huge mountains and little peaks or deep valleys. And then divergence. An indication that the end of the current trend may be near occurs when the MACD diverges from the asset. A bullish divergence occurs when the MACD indicator is making new highs while price fails to reach new highs. Now, it's not saying the MACD indicator is telling it's moving up, but the indicator itself, if you were to draw a line across the indicator on the bottom, you're seeing it move in one direction while price is moving in generally the opposite direction. Divergence, like I said, is something I don't use. Lots of people swear, and all indicators give you divergence. So then we come to the histogram, and the histogram is an indicator of an indicator, where we are 4 derivatives removed from price. So what's the first derivative? It's the 12 period minus the 20, or the 12 and the 26 period moving average. Then we get the second derivative, which is the MACD, which is the difference between the 12 moving average and the 26 moving average. The third derivative is the MACD signal line, which is the 9 period moving average of the MACD. And then the fourth derivative is the MACD histogram, which is the MACD less the value of the signal line. So it's an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in the price momentum of the underlying security. So I'm going to share with you a little presentation on how to combine MACD with other indicators to try to determine what position you might want to take. And then after that, we're going to talk a wee bit more, and we're going to use here several main primary indicators. They're all explained in that technical indicators guide I gave you from investing.com. Okay, and these are 3 of the...
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The Moving Average Convergence Divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of 2 exponential moving averages, which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving close together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3, Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has 2 standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of the time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4, Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5, Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. We can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the Super Trend Indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the Super Trend Indicator to change red here before taking the short trade. So now we have the confluence of 4 indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the Super Trend turning back to red.
So this is one of the ways we can combine moving averages into our trading strategy. But traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause the indicator to change direction quickly. The large number of false signals can result in a trader taking many losses, especially when you have to factor in commissions or spreads. So make sure you keep in mind that MACD does not tell you how far the asset will move. You need to rely on price action, candles, support and resistance lines to make that. Now, the MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transaction signals help minimize the subjectivity involved in trading, and the crosses over the signal line make it easy for traders to ensure they are trading in the direction of momentum. Very few indicators in technical analysis have proved to be more reliable than the MACD, and this is a relatively simple indicator that can quickly be incorporated into any short-term trading strategy. So if there was ever a quest in the world of investing on par with the search for the Holy Grail, it would be acquiring the ability to spot trend changes. There are many ways investors attempt to do this with varying degrees of success. But a common trend tracking tool is the 2-line moving average crossover and convergence and divergence. This tool measures an asset's momentum and can aid investors in spotting changes in market sentiment. Momentum in charting is similar to momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring the changing momentum, a person can determine when the ball will stop climbing, change direction, and descend. So just like in physics, momentum changes occur before the price of an asset changes. So the bottom line is the strength of the current trend can be measured by channeling the MACD. You can spot trend reversals by looking for divergence in momentum and determine buy and sell signals using the MACD crossovers and bounces off a channel line. Learning to implement and recognize these signals helps investors increase their profits when trading short or intermediary term trends. So remember, like life, Trading is rarely black and white. Some rules that traders agree on blindly, such as never adding the loser, can be successfully broken to achieve extraordinary results. But keep this in mind and practice, practice, practice. Do not just jump in the markets and try to trade. Use a demo account, add MACD into your trading strategy, and then when you have it down pat, then you can add it in. And remember to stay calm, take the time, take the effort, and trading and being successful in markets is all about learning, education, and risk management. So thank you very much for joining us. I hope all of you stay safe and sound out there. It's a tough time for all of us, but we will survive. So thank you very much and have a great trading week. Bye now.